Welcome. Moss Adams is pleased that you joined us for today's webcast. 2023 Spring Not-for-Profit Tax Update. Before we begin, I'm going to play a brief video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
And now I would like to introduce today's presenters, Jane Coleman and Amy Hendley, both senior managers here at Moss Adams. For their bios and contact information, it is located in your console if you would like more information. For today's program, we will cover regulatory provisions affecting tax-exempt organizations, other updates, the state of the IRS, legislation under consideration. Before we dive into our content, let's go to our first polling question. I'll give you a few minutes to respond. Please click the button next to the answer you choose and hit Submit. If you can't see the button, please enlarge the slide area. Also, if you do have an option to submit questions for the presenters in the Q&A window, we have quite a bit of content today. So if we don't have time to respond, we will do so after our presentation. We'll give a few more seconds. And here are the results. And now I'd like to turn the floor over to Amy to get the presentation started. Amy?
Great, thanks so much, Lauren. First, we're going to cover a couple of regulatory provisions that affect tax-exempt organizations. The first of which is the Energy Efficiency Materials Pilot Program, which is part of the Infrastructure Investment and Jobs Act that was passed in November of 2021. This program provides grants of up to $200,000 to not-for-profit organizations for installations that reduce energy or fuel consumption. So some of the qualifying installations are noted below: roofs, lighting, windows and doors, and HVAC systems, essentially installations that would reduce energy or fuel consumption for heating, cooling, or lighting. There is a cost share requirement for the installation of these qualifying projects that's 20% paid by the recipient and 80% potentially being covered by the grant funds. So the installations aren't fully covered. Another important note is that the building where the installation is to occur does need to be owned and operated by a 501c3 organization. There's a wealth of information on the website provided in the slide. Notably, today there's a webinar directly after this session at 12 Pacific You can register through the link that's provided if you think you may have a qualifying project and want more information. A couple of upcoming dates to be aware of with this program. June 29th, letters of intent are due, and on August 3rd, the full applications for the program grants are due. The Inflation Reduction Act has many credits which are eligible for direct payment and are refundable, generally available between 2023 and 2032. There are a few clean vehicle credits, some of which are available to individuals and others to businesses, with applicability to new and in some cases pre-owned vehicle inventory. There are also credits for both the investment in and the production of clean and renewable energy sources, such as solar, wind, biogas, or geothermal. For Section 48, which is the investment in renewals, the credit starts at 6%, and if certain credit enhancement requirements are met, the top end of the credit is 70% of the project, so it's pretty lucrative. For Section 45, which is for renewable energy production, the credit starts at $3 per megawatt hour of production, up to a top end of the credit at $33 per megawatt hour, again, if all the credit enhancements are met. Two of the credit enhancements include meeting domestically produced content or materials in the installation and the location of the projects. The requirements outlined in Notice 22-61 are for the prevailing wage and apprenticeship credit enhancement. And the link is below for the details. But in general, the terms are project wages are at rates not less than the prevailing rates for similar projects in the same locality as determined by the Secretary of Labor. And the apprenticeship requirement is 12.5% of hours for 2023 and 15% of hours for years after 23 are being performed by qualified apprentices. Projects under 1 megawatt, so for example, solar panels, this would be approximately a 6-acre equivalent, so it's a pretty large project, are exempt from the prevailing wage and apprenticeship requirements and are treated as otherwise having met that enhancement to qualify for the additional credit that's available there. Two other provisions in the Inflation Reduction Act to highlight. The first is an alternative minimum tax for large corporations. And that's at 15%, so a little bit reduced from the standard corporate rate of 21%. Large corporations had a little reprieve from AMT from the Tax Cuts and Jobs Act for tax years 2017 and forward, but now we're back to having AMT for tax years starting in 2023. The large corporation AMT applies to exempt organizations as well for those that have $1 billion of unrelated business income. It's a fairly large threshold, so it hopefully won't adversely impact too many organizations in the sector at this time, but it's not currently indexed for inflation, so will need to be monitored by organizations that do have a significant amount of EBI. Secondly, the 179 deduction was made permanent in 2020 with some changes that are favorable to the public sector that were included in the Inflation Reduction Act. 179D allowed for a deduction of $1.80 per square foot in 2020, which was adjusted for inflation for 2021 and 22. And additionally, there are changes to the deduction calculation for 23 and for future years. Unlike the refundable IRA energy credits, the 179D deduction goes to the primary designer of the installation as opposed to the owner. Previously, this deduction was only available for projects for certain for certain governmental entities as well as for-profit owners, but has now been extended to include both exempt organizations and tribal governments. Starting with tax year 2022, there's a new Form 7205 to claim the 179D deduction, which may indicate that the service will start looking at these a little more closely. Notice 22-50 was published in October last year and requested comments on the direct pay and elective payment provisions of Section 6417 that would allow organizations to have the Inflation Reduction Act energy credits not be limited by Section 50B3. This section indicates that credits are not allowed to be calculated on property that is used by exempt organizations unless the property is used predominantly in an unrelated trade or business that is already subject to tax under Section 511. Credits treated as direct payment against tax means that they would be refundable regardless of whether the organization had any taxable unrelated business income. And we're speculating that these credits will be claimed on a Form 990T even if the organization does not otherwise have UBI or a 990T filing requirement. Unfortunately, at this time, it's unclear whether instrumentalities are going to be qualified to make the election because they were not specifically included in the applicable entity definition of 6417B1A. And currently, Section 50B4, similar to the provision for exempt organizations, does not allow for the calculation of credits on property used by governmental entities. No guidance has been issued yet as a result of the 20-plus comments received, but is expected in the next couple of weeks. They were promising early summer, which hopefully is soon. For the Secure Act 2.0, which provides for some provisions to improve retirement savings in the country, to offset the cost of some of those changes, the charitable deduction for conservation easements, which has been prone to abuse, specifically from syndicated type easements, which may have relied on potentially questionable appraisals, resulting in exaggerated deductions, is now required, is now disallowed if the conservation easement exceeds 2.5 times the sum of the partner's relevant basis in the partnership that's contributing the property, unless a 3-year holding period is met. Other particulars for this act related to conservation easements are noted on this slide, and we'll cover those in detail. In addition to the provisions to improve the retirement savings, Secure Act includes the Legacy IRA Act, which allows taxpayers that are aged 70 and a half or older to make a one-time gift of $50,000 from an individual retirement account to a split interest entity. So this could be a charitable remainder trust or charitable gift annuity. And this gift is excluded from taxable income, and it's effective for tax years after 2022. This may be a good planning vehicle for individuals that have charitable or philanthropic goals and are required to take required minimum distributions before they may need the income, and they may want another income stream at a later date. These split interest entities often provide for an annuity type payment during life, and when the income beneficiary passes away, the remaining funds are then distributed to the qualifying charity. The goal of this is to help charities hopefully receive a higher number of irrevocable gifts earlier than might be possible with estate distributions upon death. The law also permanently indexes the existing individual retirement account charitable rollover amount beginning in 2024, which is the first increase for this tax planning provision since it was enacted in 2006. These distributions made directly to qualifying charities count towards the required minimum distributions for individual retirement accounts and are not considered taken into taxable income of the individual that owns the IRA. These gifts are appealing to donors because required minimum distributions need to be taken every year, and they do benefit qualified public charities. We're going to turn things over to Jane to walk through some other tax updates.
Great. Thanks so much, Amy. So a few other exciting and fun updates we want to talk about. First, a friendly reminder, the IRS announced in February that tax-exempt organizations, as well as individuals and businesses, in federally declared disaster areas in California, Alabama, and Georgia are getting relief on filing and tax payment deadlines. For California, there were about 55 counties that were affected by the severe winter storms that qualify for this relief. So returns with original or extended due dates between January 8th, 2023 and October 16th, 2023 are automatically extended to October 16th of 2023. This extension includes 2023 estimated tax payments, as well as your quarterly payroll and excise tax returns. The FTC has announced that they are conforming to this automatic extended deadline, so California returns and payments have also been automatically extended to October 16th, 2023. We're really hoping that the IRS and the FTC remember that they granted us this automatic extension. Their systems tend to send out incorrect notices automatically sometimes for no reason. So we're a little worried that this might happen again this year, but we will see. And another concern is that now these K-1s with all the information for alternative investments and foreign forms and UBI may now come in later than usual. They will come in October, and we still have to file returns by 11/15. So it may be a little tough on organizations that have K-1s to report this upcoming fall filing season. So something to keep in mind. There's still time to claim the ERTC credit, the Employee Retention Tax Credit. If you haven't already looked into it, the ERC offsets payroll taxes and is refundable, and you can claim it by filing the amended Form 941, otherwise known as the Form 941X. We recently did get clarification about the statute of limitations for filing amendments to claim these credits. For 2020, the deadline is actually April 15th of 2024. And for 2021, the deadline is April 15th of 2025. And we've been seeing that some organizations that were not eligible in 2020 may be eligible in 2021 due to the enhancements of the credit. For example, for the gross receipts qualification, the gross receipts reduction that you need to show is 20% for 2021 instead of 50% when comparing to the same quarter in 2019. Also for 2021, total number of full-time employees that you can have increased to 500 instead of 100. And the actual credit itself allowed is more for 2021 as well. A few things to keep in mind with the ERC, however, just to set expectations. First, the IRS is still very, very behind at processing these claims. So do expect a long wait if you do decide to move forward with it. It's been taking the IRS on average 8 months to a year to process these ERC claims. We have some clients where it's taken up to 2 years for them to get refunds. Also, we are expecting to see audits of this credit. The IRS added the ERC to its Dirty Dozen list and has been very active with auditing this credit. There's been a lot of ERC scams out there, and the IRS is aware of this and has issued a guidance to warn against the risk of using these really aggressive third parties that would make cold calls and who are not doing the due diligence to verify qualification and really taking very aggressive stances on the ERC and the eligibility. Some common red flags that we've seen to watch out for with these aggressive third parties include if they insist on charging contingent fees, or if you receive these ERC letters that look a lot like IRS notices that may cause you to then provide some personal and sensitive information that can then be used for scams and identity theft. So I would just encourage everyone on this call to do your research on the firms you're working with on this credit and make sure your documentation is in order. When it comes to net operating losses, here's a really great summary that just shows you how confusing it's gotten. But I think it really is great highlighting the different rules on how NOLs are treated depending on when they're generated. So for pre-2018 NOLs, you can carry over 20 years, carry back 2 years, and there's no limit on how much of taxable income can be offset by these NOLs. And there are no silo rules to worry about. For the NOLs generated between 2018 and 2020, you can carry these over for an unlimited amount of years, carry back 5 years. There's no limit to how much of taxable income can be offset by these NOLs, but these NOLs are siloed and need to stay in that UBI bucket. For the NOLs generated after 2020, you can carry these over for an unlimited amount of years, but you can no longer carry these back. And you can only use it to offset 80% of your taxable income, and UBI silo rules apply. So something to think about if you have NOLs. We did get clarification from the IRS recently that if you decide to carry back a siloed NOL to a year where the UBI federal rules were not in effect, you can actually use it to offset UBI in the aggregate. So it's not limited to just that one silo in the year you're carrying it back to. So overall, between these NOL carryback changes, K-1s received after the return has been filed and foreign filings discovered after the return has been filed, it's becoming more and more common these days to amend prior year returns. The remote workforce ushered in by COVID-19 seems here to stay, resulting in the need to continue to consider additional reporting requirements. If a company has remote employees in a state where it hasn't already registered and certain thresholds are met, such as the number of days worked in that state or the amount of compensation paid, then you may need to register for payroll reporting in those states. There may be other requirements as well to complete other than income tax withholding. For example, some states ask for unemployment insurance, and you may want to look at your workers' compensation policies as well. The COVID-19 emergency declaration officially expired on May 11th of 2023. So states may not be as forgiving going forward with their COVID exceptions when looking at employees working in their state, and may become more aggressive when requesting that you register in their state. Another consideration to continue to think about are your accountable plans and reimbursement policies. You'll want to review whether you're coding these reimbursements appropriately as taxable or non-taxable income on your employees' payroll checks. For example, how is commuting defined now that employees are working from home, and how can this be applied to travel reimbursements in terms of taxability? How is the convenience of the employer rule used to determine travel reimbursements and its taxability? What are the options for providing home office equipment? How can you reimburse home office expenses such as phone and internet? So a lot of things to continue to keep in mind. Some expired and expiring provisions. The CARES Act had allowed individuals to take a $300 charitable deduction if you didn't itemize. This expired in 2021, so you can no longer do this for 2022 and going forward. Also expired in 2021 was the unlimited deduction for gifts of cash to public charities. It's now 60% of AGI instead of unlimited. And it's going back to the 50% of AGI starting in tax year 2026. And for corporations, the charitable deduction is back to 10% of your taxable income instead of 25%. Cryptocurrency has been in the news a lot lately. On January 10th, 2023, the IRS did release some guidance on it, and it said that a qualified appraiser is required when a taxpayer claims a charitable contribution deduction exceeding $5,000 for donated cryptocurrency. The IRS did say that valuations reported by crypto exchanges do not qualify as qualified appraisals. So one area that was not addressed, unfortunately, by the IRS is how to actually obtain a qualified appraisal of cryptocurrency. Because currently the IRS regulations define a qualified appraiser as someone with verifiable education and experience in valuing this type of property. And for education and experience, the regulations go on to say that you have to successfully complete professional or college-level coursework in valuing this type of property and have 2 or more years of experience. And you need to earn and recognize appraiser designation for this type of property. So the problem for crypto is that there's no official accredited professional or course-level, college-level coursework on cryptocurrency evaluation. And it's not, there's no recognized appraiser designation either for cryptocurrency appraisers. So this continues to be an area where additional clarification is needed from the IRS. An update from the California Attorney General's front, we have a new RF-1 with a new filing fee schedule. So even if your revenue is less than $50,000, the fee is $25, whereas before it was $0. Old versions of RF-1 forms received after 1/1/2022 are rejected automatically. So I encourage you to check your account status on the California AG's website and make sure it's current in case the forms got crossed in the mail. Also, the Americans for Prosperity Foundation versus Blanca case is the one where in July of 2021, the Supreme Court ruled that California's requirement to disclose donor information was unconstitutional. So that copy of the 990 that you attach to your RF-1 still does not require the donor detail. And recently, the California AG passed the fundraising platforms law, saying that starting 1/1/2023, organizations who use online fundraising platforms such as GoFundMe are subject to additional registration and reporting obligations with the California Attorney General's office. But according to their website, the registration and other requirements for this new law have been delayed to January 2024 because the AG is still working on the proposed regulations. One of the main goals the IRS has had over the last couple of years was to modernize its technology. So as a result, the IRS requires that all forms 990, EDs, TS, and Ts be e-filed. And if you don't, then you'll get an automatic letter from the IRS rejecting the paper filed return and asking that you e-file it instead. The Form 4720 must also be e-filed, and the Forms 1023 and 1023-EZ must be filed online at the IRS's pay.gov website. And exciting news, the short period filings are now eligible for e-filing as well as the returns with accounting period changes. Before, these two types of returns historically have disqualified you from e-filing. So it's pretty exciting that you can e-file them now. As many of you already know by now, there are a lot of provisions that came out of the Tax Cuts and Jobs Act in 2017 that affected the not-for-profit world, and they are still here. So they're here to stay. The provision for treating employer-provided parking as UBI was repealed years ago, but the rest of these are still here. A friendly reminder for the UBI silo rules that when looking at your investment silos, that transition rule was not grandfathered into the summer regulations, unfortunately. So organizations with taxable years after December 2nd of 2020 can no longer rely on this transition rule. In other words, if you acquired an interest in a partnership before August 21st of 2018, and it's been determined that it's not a qualified partnership interest, then you will now need to go that extra step and go through that look-through analysis to determine if there are separate, unrelated trades or businesses to see if you have any additional silos to report. And lastly, there's been an increased amount of scrutiny surrounding 501c4s who have political expenditures, meaning expenditures utilized to support or oppose candidates for public office. Last year, the Senate held a hearing to discuss the data surrounding these activities, including reviewing the current laws governing these types of activities and how these laws are currently being applied. As you may be aware, your typical 501c3 organizations are not allowed to incur political expenditures. If you do, you ultimately pay a tax on these expenditures and you risk getting your tax-exempt status revoked. But C4 organizations are allowed to make political expenditures so long as they're not the organization's quote-unquote primary activity. The IRS and Congress have been seeing an increased participation in the political process by these types of organizations, and they are somewhat concerned that the organizations and individuals contributing to these C4s are doing so anonymously, because C4s are not required to disclose their information under 990 to the IRS. So potential regulations and law changes may be coming down the road, although it's not entirely clear what it will be, but this has certainly caught the eye of Congress. One item that may be clarified is what exactly constitutes the primary purpose when analyzing political expenditures to your overall activities, because currently, if you didn't make a Section 501 each election, there's no bright line test. Also, with the election season right around the corner, I wanted to give a helpful reminder about the 527 tax for 501c4s with political expenditures. The tax is 21% on the lesser of political expenditures or net investment income. This is payable on the Form 1120 POL, and on the 990 Schedule C Part 1, there's actually a question that will prompt you to complete it. Net investment income includes interest, rent, dividends, gain and loss on stock sales, and if you receive donations of appreciated securities, you have to use the donor's carryover basis to calculate your gain or loss on stock sales. So this could potentially produce a pretty high tax liability. There's one strategy that we keep in mind here is that with stock sales, as I mentioned, this tax is the lesser of political expenditures or net investment income. You may want to consider holding off on selling these appreciated stocks and sell in a year where you don't have as much political expenditures to decrease your tax because it is the lesser of the two. Which brings us to our second polling question. I'll hand it back over to Lauren.
Great, thanks, Jane. Today's second polling question is, did your organization qualify for the employee retention credit? And I'll give you a few minutes to respond. To respond, please click the button next to the answer you choose and hit submit. If you can't see the submit button, please enlarge the slide area. And as a reminder, if you'd like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. And we'll give it a few more seconds here. All right, and here are the results. Back to you.
Great, thanks. So next up, Amy will be giving us an update on the current state of the IRS.
Thanks, Jane. For those of you who track the IRS and progress that they've made over the last several years, they've been underfunded and had staffing struggles, like many organizations, but particularly at the service. This is a photo which was published in August of 22, which provides a visual for the shortfall that sometimes the metrics that we have on the next slide can't convey. We don't necessarily have good comparables for context. This might be the only room that they have that looks like this, but it is clearly full to the brim of paper-filed returns and correspondence that the IRS was dealing with mid-2022. As Jane noted, the IRS continues to increase modernization efforts, including e-filing of a greater number of forms and lowering the threshold for the e-filing mandates to reduce paper-filed returns. However, in the process in 2022, as they're moving to a more electronic filing system, they continue to be burdened with millions of unprocessed paper-filed returns, as some of which were housed in that cafeteria. But between May of 2022 and December of 2022, they did reduce the number of unprocessed returns from 21.3 million down to 10 million. And from February of 22, where call lines for taxpayers often were, people were unable to get through and wait times were pretty high, an average wait of 29 minutes. I know for those of you that tried to call, it was a pretty frustrating venture to try to get in touch with somebody at the IRS. In addition, there were erroneous notices and intents to levy that were sent out, often in duplicate. And for taxpayers, this can be an incredibly stressful situation to get an intent to levy for, sometimes tens of thousands of dollars. And then the correspondence that was sent in return, of course, created kind of a circular loop as the notices continued to go out because they had not yet processed the written correspondence that was sent in response. So the IRS does have a letter consolidation effort in place to try to minimize the redundancy in the communications that are being sent out to taxpayers. However, the effectiveness of this over the course of the 2022 tax year, for many taxpayers was not something that they were able to benefit from. Public reports from the IRS for mid-year through their fiscal year 23 They're highlighting accomplishments, including improvements in starting and closing exams and reductions in processing time for exempt applications. But there's little formal reporting from the service in terms of areas of interest, including Forms 941X for employee retention credits and progress made on the backlog of paper filed returns and the written correspondence that's been received. Fortunately, almost 1 year later from that cafeteria photo being published, there is some movement at the IRS, and maybe there'll be some light at the end of the tunnel. We'll see. There's a new commissioner as of early April this year, Daniel Werfel, and a new director of the T.
Rob alone as of late last year. The service has publicly reported that it hired over 180 employees in 2022 in the PG sector and is expecting additional hires in 2023.
From their strategic operating plan that was issued April 5th of 2023 that outlines their 5 main objectives that the IRS is going to focus on are aligned with the spending that's noted on the slide. Specifically, we want to highlight that they had allocated $45.6 billion for enforcement. That includes examinations and collections, efforts focusing on high-dollar non-compliance, and, of course, the digital asset monitoring that's on the Dirty Dozen list. Other efforts that they had included with the strategic operating plan included improving technology, both for internal operations and to improve services to help taxpayers meet their compliance requirements, and hopefully to more quickly resolve taxpayer issues. And hopefully we see some improvements in call wait times and correspondence replies from the service, and then to build a robust workforce to serve taxpayers. So hopefully the funding that they're getting that may be overdue will be helpful in executing on their strategic operating plan. They've also implemented and rolled out a new communications tool, which is a web-based taxpayer digital communication secure messaging platform. And this is a way for exchange of information, including documents between taxpayers and examiners. So you don't necessarily need to dust off your fax machine if you receive an exam notice from the service. They'll set up this secure messaging platform to communicate and exchange information with you. Having used the system personally, it is fairly easy to use and built in pretty secure, so we're looking forward to being able to communicate more effectively with the service. They've also indicated that they're debuting a new revenue agent training for examinations to help make the exam process nationwide more consistent. As part of the debt limit deal that just passed, that original $80 billion that was allocated has been reduced by $21 billion in the supplemental funding, so we'll have to stay tuned for changes to the operating plan as a result of this clawback. IRS examinations continue to include the data-driven exams that they started several years back, which are identified through cross-referencing of multiple forms and sources to determine where non-compliance may exist.
One recent example that the service executed was the monitoring for compliance on excise tax on executive compensation over $1 million under Section 4960. The IRS sent out compliance check letters that targeted organizations with employees in Part 7 of their Form 990 who received reportable compensation over $1 million or more but did not file a Form 4720 for the corresponding tax year. Many of the organizations that received these compliance letters had employees that had compensation for medical services, which is specifically excluded from the definition of remuneration, or were fiscal year filers that received letters for a tax.
Amy, I'm sorry to interrupt, but unfortunately your audio is breaking up. Is there any way we can quickly adjust that?
Okay, is this a little better?
That is. Thank you so much.
Yep, you're welcome. So I'll go back and talk about the 4960 compliance check letters. So these targeted organizations with employees that had greater than $1 million reported in their Form 990 but did not file a corresponding Form 4720. Many of the organizations had employees that did have compensation for medical services, which was specifically excluded from the definition of remuneration, or they were fiscal year filers that did not have fiscal year filers that did not were not subject to 4960 for that tax year. This is just a good reminder for organizations out there that the IRS has a relatively easy way to identify potential noncompliance with this section, and that applicable tax-exempt organizations should be tracking covered employees, as this tax is not set to be indexed for inflation as of current legislation. As a quick refresher, a covered employee means an employee, including any former employees of applicable tax-exempt organizations, if they're one of the 5 highest paid employees for the taxable year, or if they were already considered a covered employee of the organization for a preceding taxable year. And this is for tax years beginning after December 31 of 2016. And then there's a tax year where we have to track the covered employees, but the tax doesn't apply. And then the Section 4960 tax applies to tax years beginning after January 1 of 2018. And a good note to remember is that once a covered employee, the employee is always a covered employee, and that the definition for 5 highest paid employees for purposes of covered employee is different from the definition for Form 990 Part 7 purposes. Another example that the IRS provided in terms of the data-driven examinations is a review of 990N e-postcard filers that exceeded the 50,000 average gross receipts threshold required to file the postcard. The service evaluated other filed forms that they had received, including payroll filings, non-cash contribution forms, along with other data to identify potential filers over threshold, and then contacted those taxpayers. The IRS continues to indicate that they're looking at other ways to data mine and engineer methods for identifying taxpayers and issues for examination. There's also compliance strategy examinations that are focused on recent tax legislation that we've talked about, including the amended Form 990Ts to file those carryback NOLs that were allowed from 2018 through 2020 under the CARES Act, and the employee retention credits that are claimed on those amended 941s. The service continues to focus on payroll exams, which can be particularly broad in their coverage and require a lot of data to be provided by the organization to the examiners. These exams are generally looking for support for 1099s and W-2s that are issued to the same individuals. They're looking at a review of a lot of vendor payments and employee payroll records to ensure that withholding was done correctly, evaluation of benefits that were provided to employees and whether they were appropriately treated for payroll and income tax purposes, and the review of non-resident alien employee and or students, including requesting withholding certificates and information filings that may have been submitted by the organization. These are particularly complicated examinations, so if you do receive a notice for this type of exam or any type of exam, we recommend that you contact a professional services firm, whether legal or accounting, to get assistance with interfacing with the examiners. The hospital sector has continued to be under review by the service, with fiscal year 22 seeing approximately 1,200 reviews of hospital Schedule H filings. So that's about a third of the overall population of exempt hospitals that are covered under 501R. Of this total, just over 5%, or 67, were referred for exam. 58 of those closed with a change rate of 60%, which is considered to be sort of on the low end. The continued areas of focuses during these exams are the community health needs assessment and the financial assistance policy and the availability of those, either on the hospital's website and through other sources, adherence to community benefit standards, and compliance certainly with other types of filing, including the 990T. They did close 19 exams on Form 990T for these hospitals with an 89% change rate, meaning that they found on 89% of the returns that there were some changes that needed to be made. The main issues, of course, are usual culprits that we've seen in past years, expense allocation methods, which the IRS often targets, overall expenses that are in excess of income, and then net operating loss adjustments. We're entering kind of our third round of CH&A requirements for this year under 501R with many of our hospital clients, and so we expect that the IRS will continue to review Schedule H with interest. The tax-exempt government and government entities division of the IRS TEGE continues to work on strategies from prior years. So that includes worker classification, employee plans, the Form 990N filers that we talked about earlier, and they had executed that exam process. The excise tax on excess compensation, 4960. So make sure you're going back and checking your covered employee lists. And then W-2 and 1099s issued to the same person. Another is the tax-exempt bond world, where tax-exempt bond compliance is incredibly important, and we have arbitrage violations that the service is looking at. Priorities for fiscal year 23 include the syndicated conservation easements, which we talked about before, and some of the same items that we've referred to in previous slides. Other areas include private benefit and inurement. They're going to certainly continue to look at potentially abusive promoter schemes, and then improving operational efficiencies and developing the TEGE workforce. Because we're getting close to time, I'm not going to cover the priority guidance plan items specifically, but I do want to highlight two that are not noted on the slides. One is that guidance under 6104C was issued in August of 22, which governs the circumstances under which the IRS may disclose certain information to state officials regarding tax-exempt organizations. So the new information that the IRS can disclose includes information about proposed revocations, proposed denials, even before a final revocation or denial has been issued. State charitable organization monitoring continues to become more streamlined and has been expanding to more online filings, and they've been creating better communication channels between the jurisdictions. So this additional information from the IRS will continue to expand the state's abilities to monitor the exempt activity within the jurisdictions. And then also not noted on this slide are any potential changes that might occur if changes to the donor-advised fund landscape are passed. So the Schedule A of Form 990, which has the public support test calculation, currently distributions from the donor-advised funds are treated as being received by the sponsoring organization, which is typically a public charity and therefore is considered 100% public support. If the donor-advised fund rules change, the public support calculation could be materially impacted. And now we have our third polling question. I'll turn it back to Lauren.
Great. Thank you so much, Amy. Third polling question. Have you received any IRS correspondence this year? I'll give you a few minutes to respond. Please click the button next to the answer you choose and hit submit. If you can't see the submit button, please enlarge the slide area. For those of you who would like a copy of today's slides, you could go download them from the folder that says slide deck and handouts. We will also be sending the slides by email tomorrow, along with a recording of the webcast. As a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, and here are the results. Back to you.
Thanks, Lauren. So next up, I wanted to chat about some legislation that's been under consideration that we believe is important to highlight because it gives you an idea of what Congress is trying to do and what they're thinking. First up, athletics have been in the news a lot recently, specifically the compensation that's being paid to the coaches at these higher education institutions. It's getting a lot of scrutiny. Oftentimes, if you pull up a 990 from any of these tax-exempt colleges and universities, you'll see that the football and basketball coaches are by far the highest paid individuals. And Congress has taken notice and has been concerned about how these coaching contracts align with the tax-exempt status of these colleges and universities. In late 2021 and 2022, the chair of the Ways and Means Subcommittee on Oversight requested information regarding coaching contracts. The main areas of inquiry were, one, how the athletics program and facilities further an educational purpose, and two, how the compensation and perks paid to or for these current coaches, and also paid to or for the former coaches and their severance package compared to the student aid provided for football and basketball athletes. We're highlighting this because currently the public institutions are actually exempt from that Section 4960 tax on compensation over $1 million. So this could potentially be a precursor, perhaps, to extending that law to public institutions, which can be a big hit because some of these coaches get paid millions and millions of dollars. Additionally, something else that's been in the news a lot is the name, image, and likeness, otherwise known as the NIL payments. In September of 2020, there was legislation introduced which would prohibit individuals and organizations from using their charitable tax deduction for specific contributions if it goes to compensate incoming college athletes for their use of name, image, and likeness. It hasn't passed into law yet, but wanted to highlight this since this NIL has taken over college sports, and so Congress will most likely create more tax regulations around it. Next, I wanted to talk about the Treasury Department Green Book proposals. So every year, the U.S. Department of Treasury releases its Green Book proposals, and this was released in March of 2023. Essentially, this outlines the Biden administration's tax policy priorities. It's important to keep in mind that these are only recommendations. Ultimately, it's Congress who decides what gets enacted. But two of the included proposals could have significant impact on qualifying distributions for private foundations when giving to donor advised funds, as Amy mentioned before. So private foundations, as you are aware, they in general are required to distribute at least 5% of the total fair market value of their non-charitable use assets from the preceding taxable year. Otherwise, they're subject to a 30% excise tax on the undistributed amount. Under the current law, a distribution from a private foundation to a donor advised fund at a sponsor organization that's a public charity all count as qualifying distributions towards the 5% requirement. However, under the Green Book proposals, it's saying that grants to a donor advised fund from a private foundation will not meet their 5% distribution obligations unless that donor advised fund then makes a qualifying distribution by the end of the next taxable year. So again, this also has repercussions for the sponsoring organization of the donor advised fund because then they would probably have additional reporting obligations back to the private foundation that gave them the money. Another item I wanted to highlight, the Green Book proposals, is oftentimes private foundations get help in meeting their 5% distribution requirement through payments to disqualified persons in exchange for personal services, so long as those personal services are reasonable and necessary. The Green Book proposal is now saying that should change, and it's saying that paying compensation or reimbursing expenses to a disqualified person other than to a foundation manager who is a family member and a substantial contributor would not count as qualifying distributions. So that's been interesting, and we will see where it goes. Moving on to the ACE Act, this has been in the news a lot over the last few years. It was introduced in the Senate, and it's currently stuck in the House still. There hasn't been any movement on it since, but it's been still a priority of Congress. It's still getting a lot of support, so it's still in the pipeline. In general, there's been a very dramatic increase in taxpayers' use of donor advised funds over the last few years. It was reported in the National Philanthropic Trust DAF report for 2022 that contributions to DAF totaled about $72 billion. and the average payout rate was about 25%. So in other words, nearly 75% of total DAF assets were maintained in the accounts and not distributed out to 501c3 charities and other qualifying organizations. So Congress is concerned that taxpayers are getting that charitable tax deduction up front, but the funds are not actually going to charities and used for charitable purposes. So overall, with the ACE Act, Congress is really trying to achieve two main goals. The first is that mismatching in timing between when the taxpayer receives a tax deduction for the DAF contribution and when that charitable organization actually receives the funds. And number two, limiting perceived perpetual donor control. So the ACE Act, a few mechanics here, hopes to create new categories of donor advice funds, qualified and non-qualified, each with different tax consequences to the donor. So for the 15-year DAF, a donor would get upfront tax benefits, but only if the DAF funds are distributed or advisory privileges are released within 15 years of the donation. For 50-year DAF, the donor would not receive income tax deduction until the donated funds are distributed to the charitable recipient. And for community foundation DAFs, it's proposing an annual minimum payout as well as a 50% tax for failure to distribute contributions timely. Another item that it's proposing to do is having that 1.39% net investment income tax waived for private foundations if it makes qualifying distributions of 7% instead of the required 5% of its non-charitable use assets, or if a private foundation is a limited duration private foundation. You'll notice the two proposals on the left here on this slide are the same ones from the Green Book proposals released by the Biden administration for the upcoming year. So as I mentioned earlier, this is still being considered pretty heavily in Congress. So overall, we're not sure if this will get passed, but if and when it does, we will let you know. But what we think will happen is that pieces of this legislation will be enacted, just not all at once in this huge, nice package here. And with that, we have our next and last polling question. I'll give it back to Lauren.
Great, thanks, Jane. Polling question number 4, which of the legislative acts are you most interested in? I'll give you a few minutes to respond. Once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. And then also, if you'd like a copy of today's slides, you can download them from the folder that says slide deck and handouts. Give you a few more seconds here. And then, all right, here are the results. Okay. Great. Thank you, Jane and Amy, for such a great presentation today. I also want to thank the audience for being engaged in submitting your questions. If we didn't have time to answer yours, we will do our best to follow up with you after the webcast. And also feel free to reach out to our presenters if you have additional questions. If you met all CPE requirements, your certificate is available to download. A copy will be emailed within 3 weeks should you have any trouble downloading it now. Finally, here's a link to the online survey for today's presentation. Thank you for joining our webcast, and we hope you'll join us again next time.